Welcome back. In this, my fourth data update, I'm running way behind on these updates, but I need to get them done. I want to talk about two issues that often get conflated. One is country risk and the other is currency. It is true that many risky countries have volatile currencies, but I think it makes sense to separate the two discussions because their determinants are different and the way you deal with them in investing and valuation are different. So let's step back. In my last post, I looked at risk premiums in the US equities, US bonds, and that might have struck you as a little parochial because, after all, if you do not like the trade offs offered in the US markets, you could go elsewhere. In other countries, there might be countries actually, in fact, there are countries where investors actually are constrained to stay within their market. So it makes sense to start talking about the trade-off on risk and return in other countries. Are those trade-offs better? And in this session, I want to focus on two issues. The first is country risk and how it plays out in decision making. And the second is to deal with the currency question, because often when you go into an emerging market, not only do you have to deal with country risk, but you also have to deal with the local currency. So let's start by talking about country risk and why it varies across countries. At the risk of stating the obvious, some countries are riskier than others. But let's dig a little deeper. Let's think about why that might be. One, I think, is a variation of a structure I've used for companies, which is the life cycle. I've argued that young companies behave very differently from older companies, and the way you analyze them has to be different. In fact, uncertainty is greater at young companies than at older companies because the story is still being told. The same thing can be said about countries. Countries that are earlier in the life cycle, younger countries, faster growing countries, will tend to have more uncertainty, more risk than more mature countries. You also have political risk. You can take an economic system and businesses and make them riskier if you have a government that is unpredictable and volatile. So adding that on top of the existing risk can make some countries riskier than others. The third is legal risk. After all, if you operate a business, you expect a legal system to enforce your rights on contracts, on ownership. And if you have a legal system that's either dysfunctional or non-functioning, then you have a problem. Businesses become riskier. And finally, there is economic structure. Some countries, either because they're smaller or because of the accident of geography, tend to be over-dependent on a single commodity or a single industry for much of their growth. So when that commodity price drops or when that industry does not do well, the country suffers and every business in that country is impacted to the extent that they're all dependent on the economic well-being of the industry or the commodity. So life cycle, political risk, legal risk, and economic structure all play out to make some countries riskier than others. Now comes the practical question. How do you measure country risk? One way is to measure with a risk score, and there are services out there that try to do it. The only problem with these risk scores is they're not standardized. The ways different services measure risk scores are in different dimensions. For instance, I'll give you two illustrations. The World Bank has a pretty impressive array of governance indicators for 214 countries, and I put the link up there. But if you go and look at those numbers and you look at a number and say, is that a high number, is that a low number? It's very difficult to even within the database make those comparisons. There's a service I use for country risks called Political Risk Services that comes up with a country risk score. They actually look at the whole set of country risk variables to come up with the score, but their numbers go from low to high, low being for risky countries and high being for safe countries. Why low to high? Well, each service has its own rules. So country risk scores exist, but it's very difficult to bring them into investment analysis or finance because they're not standardized and not easily translated into percentage numbers. Well, the second and most widely available proxy for country risk is default risk. And here I've taken two snapshots of default risk. One is, of course, ratings agencies. I know ratings agencies are not held in high esteem by a lot of people, but they do provide measures of country risk in the form of a rating, a sovereign rating. In fact, what you see on this picture are sovereign ratings for a lot of countries. I haven't put the full list. I couldn't fit them all, but you can download the spreadsheet and see for yourself. Moody's, for instance, rates about 140 countries. And those ratings, like corporate ratings, go from AAA, which in Moody's estimation is close to default free as a country, all the way down to D, countries in default. So you see actually the sovereign rating for Moody's as of the start of 2020. And you also see a market-based estimate of default based from the sovereign CDS market. That's not available for as many countries. It's available for about 70, but for the countries where it's available, I've listed out what I've found as the sovereign CDS spread as of the start of 2020. So it says December 2020. Ignore that. It's December 2019, January 2020. So that's the second measure, is default risk. But if you're doing valuation, you want measures of equity risk by country, not just default spreads. I know there are some analysts who use the default spread as the proxy for the additional risk you charge for equity. But I add one slight layer of adjustment. And here's what I do. I start with the equity risk premium for the US, where I do the implied premium, if you remember from my last post, every month. So I feel pretty comfortable in that number. At the start of 2020, that number for the US was about 5.2%. So that's my base number. Then I look up the sovereign rating, the local currency sovereign rating for your country. If it's AAA, here's what I do. I give you a 5.2% premium. My argument being that if you're AAA, you're probably a mature market, and mature markets need to share a common equity risk premium. Otherwise, money would leave the lower premium markets and go to the higher ones. If you're not AAA rated, I look up the default spread that goes with the rating, either by looking at the market with the sovereign CDS spread, or I have a lookup table. You give me the rating, I'll give you the spread. And here's where I make an adjustment that might not be made by others. I argue that equity is riskier than a government bond, and to measure how much riskier, I look at the standard deviation in an emerging market equity index, the S&P index, and the standard deviation in an emerging market public/government bond index. So basically, I look at that ratio. That ratio was about 1.18 at the start of 2020. You're saying, what does that tell me? Based on that ratio, it looks like equities are about 1.18 times more risky than bonds. So I take your default spread as a country. So let's say it's 2% and multiply by 1.18. I get a country risk premium of 2.36%. You add that on to the 5.2%, you come up with a total equity risk premium. I know there are lots of moving pieces. You might disagree with me on steps of what I did, but here's what the world looks like to me based on equity risk premiums, on my estimates of equity risk premiums at the start of 2020. So I've broken it down as much geographically as I can, and you can see that even within parts of the world that you think of as pretty homogeneous, Latin America, Asia, there are big divergences in equity risk premiums across countries. In Latin America, Chile is a lot safer than Argentina or Venezuela. And in Asia, Singapore is basically a AAA rated. It's the only AAA rated country. I've given it the same risk premium as the US, but you also have Bangladesh and Cambodia, which are much riskier markets. If you're wondering what that box to the top right is, these are frontier markets which don't have a rating. I used to not estimate an equity risk premium for these countries, but there are people in these markets who still need risk premium. So I've used the PRS, remember the country risk scores, as a way of gauging the risk premiums by finding other countries with similar scores and using their equity risk premiums as my proxy. So for North Korea and Syria and Sudan, if that's where you plan to operate, I now have an equity risk premium for those countries. Now, some of you work in London and New York are saying, why would I even want to do any of this stuff? I work only with US companies. Really? That's what you think you do? Remember that the risk of a company does not come from where it's incorporated and traded. That would make our life simple in North America and Europe. It comes from where you do business. And to estimate where you do business, I can take the simple route and just look at your revenues. For a company like Coca-Cola, where production costs tend to be low and production can be moved, I'm going to argue that revenues are what matter. And in 2018-19, here's what the revenue breakdown looked like for Coca-Cola. The Europe, Middle East, and Africa accounted for 26% of revenues. Latin America accounted for 14.5%. North America was 42%, and Asia Pacific is 17.58%. You say, what kind of breakdown is this? Why would you lump together the Middle East, Africa, and Europe? Hey, this is not my fault. I'm just taking what Coca-Cola reported, and this is how they report their revenues. I've computed an equity risk premium for each region based on my country equity risk premiums. I've taken a weighted average based on GDPs. And then I take a weighted average for Coca-Cola based on where they get their revenues. And based on where they get their revenues, my equity risk premium for Coca-Cola is 6.17%, even though it is a US company. I'm not going to give it a 5.2% premium. Now, that revenue-based approach will start to break down if you have big production costs and your production facilities can't be moved easily. So if you're an automobile company with all your factories in India, even if all your revenues come outside India, you're going to still be exposed to Indian country risk. And at the extreme, if you have a natural resource company, an oil company, you're kind of stuck. Your production is where your risk comes from. And if I took a company like Royal Dutch and break down their production, here's what it looks like to me. And basically, given, and this was their breakdown in the most recent annual report, they get their revenues from all over the world and some risky parts of the world. And if I take a weighted average, my equity risk premium for Royal Dutch, based on where their oil production comes from, is 6.84%. The bottom line here is you need that entire picture of equity risk premiums often to value companies, because companies have become global and their revenues come from all parts of the world. Now you're saying, what about currencies? Well, what about them? Often when the discussion turns to country risk, people conflate currency and country. They talk about them as if they're connected at the hip. And they don't have to be, because with currencies you have a choice, and the key word here is choice. You can choose to value any company in any currency, and I'm going to argue that if you do it right, it should not matter which currency you pick. And with currencies, it's easy to get distracted by central banks, by exchange rate experts, by people forecasting things. So here's what I'm going to do. I'm going to go back to a very simple proposition about risk-free rates that I made in my last post about the T-bond rate and why it stayed low for the last decade. I argued that there is an intrinsic risk-free rate based on inflation and real GDP growth, which means that when you see big differences in risk-free rates across currencies, it has to come from big differences in inflation. So let's talk about estimating risk-free rates in different currencies. Now, many of you, if you've taken a finance class, have probably been told, just take the government bond rate in that currency and you're all done. Well, that might work for the US Treasury and the US dollar, the Swiss franc, maybe even the euro. You can look up the German euro bond rate. Just use the government bond rate. Implicitly, you're assuming that there's no default risk in the government, and the government bond rate is a risk-free rate. But if you have to estimate a risk-free rate in Indian rupees or Indonesian rupee or Brazilian reais, I don't think you can use a government bond rate in that local currency as your risk-free rate. I know you're saying, but governments can always print off more currency. Why would they ever default? Because they do. Half of all sovereign defaults in the last 30 years have been local currency defaults. So governments choose to default in the local currency, even though they can run the printing presses faster, because they're caught between a rock and a hard place. They can print off more money and not default, but then they debase their currency, or they can default. And it turns out that coming back from default might be easier than debasing your currency. The long-winded way, what I'm arguing for is, in some currencies, the government bond rate is your starting point, but it cannot be your ending point for your risk-free rate. You have to subtract out a default spread from that government bond rate. And to get that default spread, here's what I do. I find your local currency rating as a country. I trust the ratings engine. That's a little dangerous. And I estimate the default spread based on the rating. So, for instance, with India, at the start of 2020, my risk-free rate, my government bond rate was 6.56%. My default spread based on India's Baa2 rating was about 1.59%. My risk-free rate in rupees is 4.95%. Now, it might look like I'm bending over backwards to help Indian companies, but trust me, I'm not, because this is just my risk-free rate. I'll find a way to punish you for Indian country risk, but I'll do it in the equity risk premium. So if you use this approach, equity risk of starting with the government bond rate and backing out the default spread, you can get risk-free rates in different currencies. And here I've tried to get that for every currency in which I was able to find a government bond rate, and there are only about 30 plus currencies. Lots of currencies around the world don't have a government bond or a traded bond that I can use, but when you use the risk-free rate, so the blue portion of this graph is my risk-free rate. When you use this risk-free rate, remember, you are trusting in three things. First, that there is a government bond rate and it actually represents a traded market rate, which is a tricky thing. Second, that there's a rating for each of these countries. And third, there's a default spread that actually measures the default spread embedded in this rate. If you buy into all three, then you've got a risk-free rate in at least these 30 currencies. You're saying, what if I don't? What if I cannot find a government bond rate, or I don't trust the government bond rate? Well, there is a way around. And this goes back to what I said earlier about risk-free rates in different currencies. The key driver is differences in inflation. Here's how I'm going to use that to estimate risk-free rates in other currencies. Let's assume I can start with a risk-free rate in a currency where I feel comfortable estimating the risk-free rate. So let's say it's the US dollar. I take the T-bond rate, I assume the Treasury has no default risk, I use that as my dollar risk-free rate. And let's say you now want a risk-free rate in a different currency, Egyptian pounds, Indonesian rupiah. Here's what I'm going to do. I'm going to find the inflation rate in US dollars. And that's actually fairly straightforward because you can actually take the difference between the T-bond rate, which is a nominal rate, and the TIPS rate, which is an inflation-protected T-bond. And that difference is a measure of expected inflation. And then I need an inflation rate in your local currency. This is trickier because many countries, all you might get is last year's inflation, and the numbers might be cooked because governments measure inflation. But to the degree that you can do it, if you can give me the two inflation rates, I can adjust the risk-free rate. So if your risk-free rate in US dollars is 1.5%, and you're working with a currency with an inflation rate of 10%, and the inflation rate in the US is 1%, 10 minus 1 is 9%. A shortcut you can use is take the dollar risk-free rate, add the differential inflation. You got a risk-free rate in different currencies. Incidentally, the longer approach is more correct, where you allow for the compounding. And there's a link to this particular session that I'm going to put where you can download inflation rates for 150 currencies. These are IMF expectations for inflation. I'm not saying they're right, but you can use these to get synthetic risk-free rates in other currencies. So this approach can be useful in currencies where there are no government bonds outstanding in the local currency. This is often true in many African countries, and as you go even in parts of Asia where you cannot find a government bond outstanding. It is useful where there is a government bond but you don't trust the rate. I don't mean to cast aspersions, but that Zambian Kwacha government bond rate, I'm not sure how liquid that market is, how deep it is. I don't know how much to trust it. So if I don't trust the government bond rate, maybe I shouldn't use it. And the third is for parts of the world where the exchange rates or the currency is pegged. What does that mean? Essentially, these are countries which have pegged their currency to another currency, usually the US dollar, either for convenience, as is the case in much of the Middle East, or stability. Latin America has tried this. Argentina has tried this in the late 90s. Ecuador right now has a peg. And many analysts, when you have a pegged exchange rate, take the easy way out. What is that? They say, my currency is pegged to the US dollar. I'm going to use the T-bond rate as my risk-free rate. I've seen this practice in much of the Middle East. And you're saying, what's wrong with that? Because pegs sometimes unpeg. I mean, I gave you the example of Argentina. That was in the late 90s. By 2000, the peg was gone. You're saying, why would pegs fall apart? Because the fundamentals don't support the peg. For two currencies to be pegged, they have to have roughly the same inflation rate. So if the US dollar inflation rate is 1.5%, and your inflation rate, whether you're Ecuador or Saudi Arabia, is 4 or 5 or 10%, the peg will not hold. So for those currencies, you might actually be better off, even if there's a peg, replacing the T-bond rate with your synthetic risk-free rate, where you bring in the differential inflation. So we're almost home. So we've talked about why risk-free rates vary across currencies, and in a sense you can see why some currencies have low risk-free rates, others have high. Some might even have negative risk-free rates if you have a deflationary currency. You're saying, would it make a difference then which one I choose to do the valuation in? No, and here's why. If you pick a low inflation currency to do your valuation, let's say you have an Indian company and decide to do it in dollars, you're going to be helped when you do your discount rate because you're building off a much lower risk-free rate. So that's the good news. You have lower discount rates. But remember, in your numerator, your cash flows now have to be dollar cash flows, which means the growth rates you use have to reflect US inflation, not Indian inflation. What one hand gives you, the other hand will take away. Low inflation currencies, your discount rates will be low, but your growth rates will be low. You switch to a high inflation currency, your discount rates will go up. That's the bad news, but the good news is your growth rates will go up. And if you do it right, your valuation, your project analysis should be currency invariant. The key in both valuation and project analysis is to pick a currency and to stay consistent. What gets people into trouble is not being consistent. And I'll give you scenarios where you could get into trouble. One is what I call casual dollarization. I see this in Latin America all the time, where companies claim to have dollarized. And here's what they've done. They've estimated the cost of capital in US dollar terms. Okay, You start with the T-bond rate and you build up. You got $1 cost of capital. I can live with that. And then they project out the cash flows in Brazilian reais or pesos into future years. And then they convert those real cash flows into dollars using today's exchange rate. They say, I want to convert everything into dollars. If you use today's exchange rate, all is lost because you've now created a mismatch. And here's why you create a mismatch. When you look at expected exchange rates, you have two currencies with different inflation. Over time, the higher inflation currencies should depreciate. It doesn't always happen. It's purchasing power parity. It doesn't always hold. But when you do valuation investment analysis, if you use today's exchange rate, what you've effectively done is built in the local currency's inflation rate into your cash flows. That could be 6, 7, 8%. And the US dollar inflation rate into your discount rate. That's a recipe for quadrupling value for all the wrong reasons. So be careful about dollarization. If you want to switch to a different currency, you got to carry this through. Your discount rate has to be in the currency, and your exchange rates have to be based on differential inflation. You got to make your valuations inflation consistent. The second scenario where you can get some miscalculations is when companies talk about hurdle rates. I am terrified when companies talk about hurdle rates that they carry around the world, because those hurdle rates are often estimated in a local currency and often in the country that they operate in. So if you're a Swiss company, you might do your cost of capital in francs and your country risk is all Swiss risk. But if you take that cost of capital to Eastern Europe and you value a Slovenian or a Polish company in Swiss francs, you're going to find everything to be cheap. So I am wary of corporate hurdle rates because they create those kinds of mismatches. And finally, we're often casual about currencies. Why? Because we each have our frames of reference. Let me make it personal. Often when I talk about growth rates and discount rates, if you don't press me, I tend to think in US dollar terms because I work with a lot of US companies. So if you ask me what's a typical cost of capital for a company, I'll say about 7.5% to 8%. And that's, oh, by the way, I'm talking in US dollar terms. And the reason I emphasize that is, let's say I'm talking to an Indian manager or an Indian analyst. That Indian manager or Indian analyst tends to think in rupee terms because that's what they work with every day. It's not that I'm right and they're wrong. We have different frames of reference. But if we're casual and I say the cost of capital is 8% and the Indian analyst say, no, we use 12%. We're not explicit about what currencies we're talking about. We're going to talk in circles. And often I've seen cross-border acquisitions where you got two people on two sides of the table talking in different currencies and valuations kind of implode on you. So in the global environment that we live in, whenever we talk about discount rates, growth rates, we need to be explicit about currencies. I know it's a pain in the neck to constantly say, I'm talking in dollars, I'm talking in British pounds, I'm talking in rupees. But if we don't do it, the consequences can be catastrophic for value investment analysis. So in summary, in this session, I've looked at two variables that are often conflated with each other, currency and country. And I've argued we should separate the two because the way we deal with it is different. The determinants are different. And here's the thing to remember. If I invest in a company in a risky country, I can choose to do the valuation in US dollars, but if I do it, the company is not going to get safer. Dollarizing or doing an analysis in dollars cannot make a risky company safe. Just as taking a company that operates in a safe market and doing your analysis, so let's say you took a Northern European company, a Swedish company that gets all of its revenues in Scandinavia, and I did my valuation in Russian rubles, I'm not going to make it a risky company. Currencies are a measurement mechanism. Country risk runs deeper. You can't get rid of it that easily. So I hope you found this session useful, and thank you very much for hanging in there with me.